Hello, my name is Rebecca MacPherson, and this is my financial analysis of Barnes & Noble. Barnes & Noble was started by Leonard Riggio with one college bookstore. Since Katrina in 2005, he and his wife have gifted more than 100 homes to displaced families through a not-for-profit he created called Project Home Again. Barnes & Noble is the world's largest bookseller with 640 retail stores in the U.S. It is the second largest magazine seller, a leader in digital media and educational products. By 2016, Barnes & Noble had spun off Barnes & Noble Education, converting all preferred stock to common stock. Some of the ratios have become slightly worse from 2015 because of the decrease in retained earnings and effects of the separation. The good news is they are expected to rise in the coming years because all efforts are being focused on specific operations. Barnes & Noble's current and quick ratios tell us that they are well positioned in the market and can quickly convert their current and short-term liabilities. Barnes & Noble's current ratio is close to Amazon's, while their quick ratio is significantly less. This is because of Amazon's global reach and fast 2-day shipping free to Prime members. Amazon's inventory turnover is very high in comparison to their total asset turnover. This tells us that they can turn over their inventory faster, but are not making as much money as Barnes & Noble, who have a better total asset turnover ratio. Barnes & Noble can quickly turn over their inventory and earn more than twice as much as they put into their inventory. One of the reasons Amazon's total asset turnover is slightly lower is because they have a diversified inventory. Both companies have high debt ratios, meaning lower than average financial leverage, which tells me that they are accruing debt faster than they should, and a bank would be hesitant to loan them money without high interest rates. They both have greater assets than debts, but Barnes & Noble is slightly better than Amazon's, but slightly worse than their previous year. You may ask yourself, why are the gross profit margins so similar, but not net profit margin? For Barnes & Noble is significantly less than Amazon. This is because Barnes & Noble had preferred stockholders, which decreased their retained earnings and therefore earnings available to common stockholders, while Amazon did not have preferred stockholders. Both gross profit margins are acceptable, but being larger businesses, I would expect their numbers to be higher. Again, these numbers can be explained by the preferred stock problem. I believe these ratios will improve for Barnes & Noble tenfold in the coming years without preferred stockholders. For Amazon, it is worrying that there is such a large gap between their return on assets and equity. This shows that their assets are not as highly valued and their liabilities are significantly higher. Here you will see the common size income statement. For Barnes & Noble, only one ratio improves slightly, and that is total assets. I am hoping that with all efforts being focused on this specific operation, Barnes & Noble will be able to improve these significantly. In comparison with Amazon, how does Barnes & Noble stack up? Overall percentages, you will see Amazon is the leader. Unfortunately, I knew this would be the case going into this project because they are so diversified and Barnes & Noble is mainly books. That is not necessarily a bad thing. If we were to compare Amazon's book profits only, I'm sure we would find Barnes & Noble the leader. How does Barnes & Noble and Amazon fund their debts? Their operations. Amazon definitely uses more equity than Barnes & Noble because they have more, seen from our earlier ratios. But Barnes & Noble uses less debt than equity. Therefore, Amazon proposes a greater risk to investors. But this is also the reason Amazon is growing more rapidly than Barnes & Noble. The debt-to-equity ratio for Barnes & Noble in 2016 is 233.51%. Amazon's is 266.34%. Comparing the two, Amazon is slightly better because debt is usually cheaper than equity. Strengths. Barnes & Noble are number one in the marketplace. They are focused on reading and the experience. They earn more than twice as much for every dollar invested in inventory. They are improving education and increasing the level of literacy. Their brand is strong and attracts book lovers. They are funding their operations the cheapest way possible, which is debt, increasing the shareholders' equity. Weaknesses. Diversification. Barnes & Noble are not as diversified as larger retailers like Amazon. Their profits are in the thousands, whereas Amazon's are in the millions. If someone was looking for a one-stop easy shop, Barnes & Noble would not be it. Price. Barnes & Noble are more expensive than cheap online secondhand stores. Debt. Barnes & Noble have 70% liabilities, only seeing 30% profit. Decreased growth trend. Barnes & Noble are closing stores where Amazon is expanding more and more, keeping post offices alive. Barnes & Noble is not in a position to take on much more debt, as shown by their debt ratio. I have seen a trend in closing the least amount of stores in 16 years, and it appears that they may be opening more in the next 5 to 10 years instead of closing them. With these ratios, I do not see big banks investing loads of money into them yet, or else charging ridiculous interest. The best time to invest in Barnes & Noble is now. They are already at the top of their market, and by my financial analysis, I know they will only improve, from focusing their efforts on reading alone to their escape from preferred stockholders. While some of the ratios appear to be dropping, I believe that the trend I have seen in their previous years' financial analysis is upward, increasing shareholders' wealth. The risk is higher, but that also means that the payback will be higher if I am correct. Amazon has intermittently gained book lovers, loathing customers, but I believe this is a fad that will soon die because true book lovers want to smell the leather and feel the pages. They want to be immersed in the experience of other worlds and books, removing them from their reality. And I believe that Barnes & Noble will leap on this advantage where Amazon is busy dealing with Walmart groceries, 2-day shipping, and low profitability inventories. Thank you for watching my presentation, and I hope you enjoyed.